Everyone talks about tech startups, the founders, the ideas, the billion-pound valuations. But almost nobody asks the most important question. Where does the money actually come from? Because behind every UK tech startup, there is a hidden financial system, a system involving venture capital firms, pension funds, sovereign wealth funds, governments and global investors. And once you understand who really funds UK tech startups, you start to see something surprising. The UK tech industry isn't just built by entrepreneurs. It's built by capital networks that move billions of pounds around the world. Today we're going to follow that money. Section 1. The first money. Every startup begins the same way, not with millions, but with a small amount of early capital. Usually this comes from three places. The founders themselves, friends and family, and angel investors. Angel investors are typically wealthy individuals who invest their own money into very early startups. In the UK, angels often come from former tech founders, finance professionals, experienced executive. They typically invest £10,000 to £500,000. But this early money isn't really about scale, it's about survival. At this stage, investors are betting on something extremely uncertain: an idea, a small team, and the possibility that one day this company might become worth hundreds of millions or even billions. But angels rarely fund startups alone, because the real money in tech comes later. Section 2. Venture capital. Once a startup proves it can build something real, a new type of investor appears: venture capital firms. Venture capital is the engine that powers modern tech startups. These firms raise enormous investment funds, sometimes hundreds of millions of pounds, sometimes billions. Then they deploy that capital into startups they believe can grow extremely fast. In the UK, some well-known venture capital firms include Balderton Capital, Ingis Ventures, Atomico, Accelo. But here's something most people don't realise. Venture capital firms aren't investing their own money. They're investing other people's money. Which leads to a much bigger question. Where does that money come from? Section 3. The real source of VC money. Behind every venture capital fund are limited partners. These are the institutions that actually supply the capital, and they include some of the largest financial entities in the world. For example, pension funds. Millions of people saving for retirement indirectly invest in technology startups. Large pension funds allocate part of their portfolios to venture capital. Why? Because venture capital offers the possibility of extremely high returns. A single successful startup can return 10x, 50x, or even 100x the original investment. But pension funds aren't the only investors. There are also sovereign wealth funds. These are investment funds owned by governments. Countries like Norway, Singapore, and the United Arab Emirates invest billions globally, including in technology companies. Then there are university endowments. Some of the world's largest universities invest heavily in venture capital. And of course, there are institutional asset managers, huge global firms managing trillions of dollars. Together, these institutions form the capital base behind venture capital, which means the money funding UK startups often comes from all over the world. Section 4. Government money. But private investors aren't the only source of funding. In the UK, government funding plays a major role in the technology ecosystem. One of the most important organisations is Innovate UK. Innovate UK provides grants and funding to help startups develop new technologies. These grants can support artificial intelligence, cybersecurity, biotechnology, clean energy, advanced manufacturing. The government isn't necessarily looking for immediate profit. Instead, it invests to strengthen national innovation and economic growth. There are also research funding programs connected to universities. Many successful tech startups actually begin as university spin-outs. In places like Cambridge, Oxford, Imperial College London, researchers develop new technologies. Then investors step in to turn those technologies into companies. This creates a powerful innovation pipeline: research, funding, commercialization. Growth. Section 5. Corporate venture capital. Another surprising source of startup funding comes from large corporations. Many major companies operate corporate venture capital arms. These are investment divisions that fund startups working on technologies relevant to their industries. For example, a large bank might invest in fintech startups. A telecom company might invest in AI or network technology. A pharmaceutical company might fund biotech innovation. Corporate venture capital allows large companies to access new technologies, monitor innovation trends, potentially acquire startups later. This means startups often receive funding from a mix of venture capital, corporate investors, institutional funds, and government programs. Section 6. Why investors fund startups. At this point, you might be wondering, why would investors take such huge risks? The answer lies in the economics of venture capital. Most startups fail. In fact, many venture investments lose money, but occasionally one startup becomes extraordinarily valuable. A unicorn, a company worth over $1 billion. If an investor owns even a small share of a company that reaches that level, the return can be enormous. That single success can pay for dozens of failed investments. This asymmetric return profile is what drives the entire venture capital system. High risk, but potentially extraordinary reward. Closing. So who really funds UK tech startups? It's not just founders, not just venture capital firms. It's a global network of capital, pension funds, sovereign wealth funds, institutional investors, government innovation programs, corporate venture funds, and global financial markets. Together, these investors move billions of pounds into technology every year. And that capital shapes the future of innovation. Because behind every startup, there is a financial system deciding which ideas receive funding and which never get built. And understanding that system is the key to understanding how the technology industry really works.